Not to do it. That's right. Don't be out here naked. All right. So you may have to buy the stock at the strike price. That's the biggest risk. So remember that when you sell a put, what you're doing is you're selling someone an option. And the option that they have is that they can sell you their stock whenever they want to. So if you sell a put option that is naked, that means you sold the put, you sold somebody the rights to sell you their stock, but you don't have any capital to back it up. That's not only crazy, but that's not going to be allowed. If you go into your account right now and try to sell a naked put, they're going to say you cannot do this. So, because what that is that's like those old school insurance companies that they used to, that some of them used to be in black communities or they used to rob black communities, where they would sell people, a bunch of people insurance, and they would pay the policy amount. Anybody know, remember that? Well, they would pay the amount of the policy, and so somebody might pay the policy for 20 years, and then when somebody dies and they try to collect, they don't have the money, right? That's illegal. That's illegal. You go to jail for that. So naked. So don't be out here naked. That's the moral of the story. All right. Next question. You own 100 shares of stock and you sell a call option against it. So you sell a call against your 100 shares. What is that called? Now I know y'all know what that's called. Come on now. Come on. What is it called? Put it in there. A, is it called a naked call? B, is it a protective put? C, is it a covered call? D, is it a cash secure put? Which one is it? C, there we go. That's an easy one. That's like, yeah, that's like asking which president's name rhymed with Barack Obama, right? I mean, that's an easy one. Yeah, so let's go through this though. A naked call is when you sell the covered call, but it's not covered, so you're naked, which is bad. A protective put is where you buy a put and you're protecting something. Puts can either be used for protection or speculation, one or the other. You're either betting on something happening, or you're protecting against something bad happening. So I can buy a put. If I buy a put, I bought a put for speculation on Oracle. When Oracle made their deal, I didn't believe it. I've said Oracle's full of crap. This is not. This company's gonna. The stock price is gonna sink. People are overpaying for it. So I bought some puts on Oracle, and they made money because when the Oracle price dropped, the puts went up in value, and then I sold them, and I was done. So you can buy puts for speculation or protection. A protective put is what you might do right now in this economy where the market is really volatile. This is a crazy market. And so with the market being crazy, then puts can be your friend. And a lot of people don't want to buy puts until it's too late. They want to get their insurance after the house is burned down. Ain't no insurance company going to sell you insurance after your house is burned down. A cash secured put is where you're selling the put and you're securing it with cash. So you got the cash. You're saying, "Hey, I've got cash here just in case this disaster happens or this stock price drops." So you're selling insurance to somebody else. All right, next question. You notice your call option is losing value every day, even though the stock price hasn't changed. What's causing this? A, delta. B, gamma. C, theta or time decay. Or D, broker's fees. What's causing that? Now I know y'all know that one. That's time decay. That's theta. All right. So let's I'm gonna keep it. All right. So that's easy. Time decay is where the value of the option drops just because time is passing. So time is really valuable in the world of options. Options that are stacked up with more time are like a suitcase that's full of more clothes. They have more value because there's more stuff. There's more there. There's more things that can happen if you give something enough time. Then many things can happen. And you've always known this, right? It's kind of like if somebody is out doing stupid stuff in the world and they say, well, I was being crazy for the last year and nothing bad happened to me. Somebody will say, well, just give it enough time. He gonna learn. Eventually he's gonna learn, right? And he may not learn today, but he's gonna learn eventually. So to some extent, that's kind of like with options. When you add more time into an option, what it does is it says the more time passes, the more things that can happen. And remember, when you buy an option or sell an option, what you're buying and selling is you're selling hope, you're selling possibility, you're selling probability, you're selling risk, You're selling volatility to another party. You're selling this chance that something else could happen. That's what people buy options for. They don't buy options because they're valuable. They buy options because they could be more valuable. Do you understand? It doesn't mean that they won't be costly in the moment and have some value in the moment, but that value is kind of like unused, unrealized potential. The unused potential is not the same as realized potential. Those are two different things. So when you buy an option, that's what people are buying from you, is that gunpowder that's in the gun that might blow up and explode. So sometimes you are able to generate your cash flow by selling that potential to somebody else, and just saying, okay, I don't really need to know, what happens with this stock. I would rather have certainty. Right. That's the thing. People that sell options are people that sometimes they just want to generate certainty. They're like, look, I'd rather have $100 now than the chance to make $500 later, because I ain't got time. I don't want to wait. I don't want the risk. I don't want to wonder. I just want to know. So tell me what I got, and you give me money, and I'll give you all the risk. Right. That's what happens when you talk about buying and selling options, and that's why it's a multi-billion-dollar market. Moving on. One standard option contract controls how many shares? So that's easy. Y'all should 10 shares, 50 shares, 100 shares, or 1,000. Answer in the chat. Answer in the comments. All right. Let's see. I'm not even going to talk about that one. That's just like baby level stuff for y'all. Y'all too smart. All right. What does the delta tell you about the option? A, how much money you'll make or lose per day. B, how much the option price changes when the stock moves by $1. C, how many days until expiration, or D, the probability of assignment. It's B, how much the stock price moves, or the option moves and the stock price moves by $1. Delta is a derivative. In mathematics, they use delta to define derivative. Or another way to describe it is what they call the rate of change, right? So your derivative, like in your car, if you're driving 50 miles an hour, somebody could say your delta is 50, right? Which means in 1 hour, it's always relative to time. So they would say in 1 hour, they drove 50 miles, so delta would be 50. And so then what happens with a derivative, though, is you have other aspects of a derivative. Derivatives can go up or down, and they would call that like second derivatives. That would be like acceleration. So if you're driving a car and you're going 50 miles an hour and you hit the gas and you suddenly accelerate to 80 miles an hour, then what happens is what a mathematician would say is that your second derivative is positive, that you're changing at an increasing rate. And then there's even another derivative on top of that. It's the acceleration of your acceleration, right? How fast are you accelerating, right? So maybe for an hour I'm going 50, 51, 52, 53, and then the next hour I'm going, 80, 85, 90, 95, 100, right? So I'm not just accelerating, but I'm increasing at an increasing rate. And so these are mathematical terms that apply to your investing. One of the biggest mathematical terms that you really want to get familiar with is something called convexity. Convexity is basically a way to describe it would be either increasing at an increasing rate or decreasing at an increasing rate. So literally, stocks move with convexity. Like, so if I was to show you like a chart of how much money you had if you were investing like $100 a week, and you kept doing that consistently, then what would happen is you would see the curve like kind of be really flat for a while, and then all of a sudden it would be like a rocket ship. Right? Anybody ever seen that where you just have this big rocket blast off out of nowhere, where suddenly the world changes? Suddenly, it's instead of it being hard to make money, it becomes very easy to make money because your money is making money. That is compound interest. Compound interest is it is convex. It increases at an increasing rate. At first, it feels very, very slow. This is why investing is so deceptive. This is why people don't do it, because they start doing it and they're like, okay, where's my money? It's not coming out fast enough. But the people that make the money are the ones that are consistent, because then they get to dig into the convexity, and then the convexity just takes off. It's like viruses have convexity too. Like if you have a virus that spreads, like if somebody has COVID and there's like 20 people in the room, and then that person gives COVID to a bunch of people, it's not like the whole country has COVID, but eventually the virus starts spreading at an exponential rate, and that's convexity. So if you look at the chart of numbers of people that have the virus, at first it's kind of like this and it's increasing slowly, then suddenly it's like kaboom, right? And that's convexity. Convexity is your friend. Convexity is what's going to make you rich. Convexity occurs when you are consistent. Convexity occurs dollars when you use compound interest. And convexity is powerful because convexity really becomes explosive when you blend consistency and time. When you are consistent for a very long time, then what happens is that your wealth grows at a convex rate, increases at an increasing rate. So that's why I've consistently told you, if you want your children or grandchildren to be wealthy, start investing for them consistently when they're newborn babies. Invest for them before they're born, because you got more time to put into the process. So you put 30 years into that process, there ain't no reason why that baby can't be a millionaire. It's very easy to make a child into a millionaire if you have 30 years of convex compound interest working in their favor. It's really hard to make them a millionaire if you do nothing and you waste 30 years and then you throw them out in the world and they're flat broke. That is not a plan for wealth. That is a plan for extreme poverty. So the question is, what are you going to plan for, poverty or wealth? It's up to you to make that decision. All right, moving on. Next question. A straddle involves buying a call and a put at the same strike price. So buying a call, so you're buying a call and you're buying a put, same strike. When does this make money? A, when the stock does not move at all. B, when the stock makes a big move in either direction. C, only if the stock goes up. Or D, only during the first week. What's the answer? All right, Karen Green got it. It's B. Yep. Because remember, when you buy a straddle, it's like this. It's like, remember the strangle's like field goal and the straddle's like this, like happy birthday, right? Or, go team, right? So basically, the reason it looks like this is because this shows each arm represents the money that you're making as the stock price moves. So straddles are are really of interest during times like right now when the market's really volatile, because the odds of a stock moving quite a lot are very, very high. But remember, I told you all, even though straddles are very tempting, I don't really mess with straddles that often, because they just, I don't know. It kind of sucks because it's not an underpriced phenomenon. It's overpriced. And so let's look at an example. So let's see. Let's look at Nvidia, since Nvidia is kind of the hot stock this week. All right. So Nvidia, I'm gonna put Nvidia in here. And then let's say that I had the genius idea of saying, I'm going to buy me a straddle. I'm going to buy a call and buy a put at the same strike price, and I'm going to make $1 trillion. All right. So here for November 28th, I could buy a call. The price is 181. I buy a call with a strike of 182.50, and I buy a put with a strike of 182.50. So the call cost me 530. The put cost me 675. What's my cost on this? $1,206. Okay. So here, the question then I must ask myself is, what is required for me to make money with this strategy? What has to happen? Remember, an option has value, but the value is based on unrealized potential. So the question is, how much potential has to be realized for this to be a worthy investment? Because the clock is ticking. I got 7 days for Nvidia to do something special and make me rich. Well, if I want to know how far this stock has to move in either direction, it either has to go up by 5 or 6, which is what's that, $11 and $12.05. So it has to go either up to 193.60, or it has to go down by $12.05, right? Which would be, I guess, about 169 ish, right? And it has to kind of move fast for that to work out. So I'm not saying don't do it. I mean, actually, it's kind of interesting, right? Remember, the thing about it, though, it's like a strategy like this, to me, if you're doing this, you're not behaving like an investor per se. You're more like you're a speculator, and that's okay too. But that's not investing is like a diversified portfolio of assets that are income generating companies that are going to grow over time, that are going to build your wealth. This is where you're placing a bet over what's going to happen with the stock over the next week. Those are two different behaviors. And so so it's the same way, like, if I'm on a one night stand, then I'm not a married man if I'm on a one night stand, right? That's not me. Me on a one night stand is very different from me choosing to like be married. Like, those are just two different dynamics, two different processes. So here it's the same thing. I don't know. I don't do it because I just don't. It's like, no, I mean, what am I trying to do? Give myself a heart attack? Am I trying to am I trying to like inject some dopamine in my brain from the excitement of watching the stock go up, which is pretty much what you get at a casino. And so to me, taking a bet like this would be a lot like betting on whether I think the Cowboys are going to beat the Giants. Now, because none of this really connects directly with the long-term impact of this asset. What you are betting on as well is you're betting on sentiment. Maybe you see the market now in the dip and you say, I think the market's going to get a little more confidence over the next week. I think that Nvidia is going to benefit from that, and people are going to realize that they mistreated Nvidia a little bit. Nvidia is a better company than people are willing to admit. I can't tell you that's completely true though, because nobody really knows what the true value of Nvidia is. We're just guessing. So if Nvidia stock drops, that does not mean that the price is lower than its true economic value. It just means that the price dropped. That's it, right? So really, so maybe though, I don't know if I have a belief. Let's say that I believe that Nvidia is gonna either move way up or way down in the next year or something, and I can make it more investment like by maybe switching these expiration dates all the way out to December of 2026, and I keep my strike prices 183. Um, Now I got a bigger burden though, so I put down $7,000, and my burden is massive. If you add up the prices I'm paying for this asset, $38 plus 32, that means that Nvidia has to move $70 a share in the next year. So the question is, do you believe that Nvidia in the next year will either go to 250 or down to 110? If you believe that, then a straddle will be for you. I don't believe that. I don't. I just I'm not trying to put my money into something like that. If I got $7,000, I'm gonna just go buy me some stock in the company and just let it sit there and put that money into Google. It may go up, it may go down, but it probably isn't going to go to zero. But that option could go to zero. If what you're predicting to happen does not occur, then the option will go to zero. Now, one thing I want to mention as well, since we're on this, somebody give me another stock. Give me another stock. I'm going to show you one more thing that I want you to kind of, if you are dealing with options and you want to feel like an investor, this is something that I think is a strategy that you may want to keep in your back pocket. All right, so Palantir. All right, so Dwayne says Palantir. All right, Palantir is a very interesting company. All right, so let's go to Palantir, and let's say that Dwayne looks at Palantir and says, "Man, Palantir is getting a bad rap. I believe Palantir is gonna resurrect itself and go back up." All right. Well, what you can do is you could do a stock replication strategy. Now, this is not listed here as any strategy. It might involve. What it does is it involves buying a call option, but you're buying a call option that's already in the money. So the current price of Palantir is 155. So what I might do is I hit buy to open and let's say one, and I pick a date way out in the future. So let's go out to 2027. Right? I give myself a little over a year, and my strike price I pick. Let's see, the current price is 155. I pick a strike price of like 120. Now, mind you, um, wait, let me see. Buy to open January 15th. Strike 120. Wait a minute. Oh, I see what's going on. I was like, "Ooh," I was a little worried. Okay, sorry. I was looking at the price. They put a price in there and it threw me off because I hadn't picked a call or a put. And I was like, how in the hell is that price 20? And the reason that threw me off is because so let me explain what it is, then I'll explain why I froze for a minute because I was confused for a second. Basically, what you can do is what they call a stock replication strategy. So if Dwayne believes Palantir is going to have a good year, and he doesn't know exactly when it's going to happen, but he gives himself a year of elbow room to kind of wait around. And let's say that he doesn't want to really pay the full price for Palantir stock, but he wants a piece of the action. Well, the price is 155. He could buy a deep in the money call option with a strike of like 120. The fact that it's deep in the money reduces the probability that this thing is going to expire worthless, so it feels a little less risky. But when things are less risky, they tend to be more pricey. You pay for safety for the most part. If you want to pay less, then you got to take some more risk. So you're making that trade between money and risk. Okay. All right. So here in this case, here's the deal. Like, so let's say so in a way, if you think about it like dating or marriage or something, because I really think of buying stock a lot like marriage. Like I think like marrying someone is like buying a stock because or the relationship goes up and down, but you're just kind of there holding on. You're buying and holding, right? Whereas in this case, this is like a long-term relationship. So here you don't want to actually own the stock, right? But you want to get connected to the stock in a certain way. So what you're doing here is you're picking a strike price of 120, which is far below the stock price of 155. So the option is deep in the money. what they call the intrinsic value is the value that you could earn if you exercise that thing right away. So if I have a stock at 155 and the strike price is 120 and I exercise that option, which means I can buy it at 120, then I will make $35 a share. That would be a mistake because the price of the option is not $35, it's 61.70. So this is and what is the 61.70? Why is it 61 instead of 35? Well, because the rest is what they call the time premium. That is hope. That is unused potential. That is possibility that you're purchasing. You're purchasing possibility, and somebody else is selling you possibility because they're basically saying, "Hey, give me this money, and you can have whatever potential, whatever upside my stock has, but I need you to give me this money right now. That's how we're going to trade." So here, why might Dwayne do this? Well, he's paying 61 instead of 155, so he's not paying as much as he has to pay in the stock. And also, here's the thing: if you would look at the delta on this long-term deep in the money call option, the delta will be very high, probably like 0.7, 0.8. That means that for every dollar that Palantir moves, he's making 75, 80 cents on that dollar. So if he's a bull on Palantir and then Palantir shows up bullishly, then he's going to make money on this asset without having to deploy as much capital. Now, what can go wrong? You should always ask yourself that question. Well, if Palantir goes south, like a lot of people believe the AI bubble is going to burst. A lot of people believe Palantir's whole valuation is garbage. They believe this stock is going to go straight to hell. So if Palantir drops from 155 down to below 120, he loses his whole entire investment. Okay, so that's kind of the risk that you're taking there. You're putting up the 6,000, and you're saying, hey, I'd rather put up 6,000 to have rights to 100 shares. As opposed to putting up 15,000 to have ownership of 100 shares. But here's the other thing too. This is one other benefit of the strategy that people don't talk about, which is that even though he could lose everything, he still has extremely limited liability on this stock. In fact, owning stock is already what they call limited liability. That means that if you own stock in a company and the company goes bankrupt, the bankruptcy court isn't going to come get your assets. That's one of the interesting inventions of capitalism is they set it up where you can make investments in, like I can invest in IBM, and if IBM goes bankrupt, all I lose is the amount I invested. They're not going to come get my house and my cars to put it toward the bankruptcy. So that's limited liability. So as an equity holder, you always have limited liability, which means the most you can lose is what you put up. When you buy a deep in the money long-term call option like this, or they might call it a leap, you have limited liability. So not only are you limited, but you're even more limited than other people. So even though he could lose his whole $6,100, that's still not as bad as it would be if he actually owned the stock. So imagine if this stock drops from 155 to 90, right? Well, so if you own this option, you're going to lose everything. You're going to lose the whole $6,170. Ain't nothing there for you anywhere. But what if you own the stock? Well, if you're the stockholder, you didn't lose $6,170. You lost, I don't know, what's the number? What's 60? Let me see, 90, 50, 65 times. You lost. You lost more than that. Basically, you lost about 6,500 because the other person paid such a big time premium. So that's why. So your losses are kind of similar. But remember, you go down as far as the stock could go down. So that stock could go down to zero. So if you own this stock and the stock keeps going down and down and down, you keep having to eat those losses. Whereas because you're married to the stock. Whereas the person who bought the long-term deep in the money call option, the leap, they're just dating the stock, right? So they're going to take a loss, but they can walk away, right? Whereas you're connected in a much deeper way. But the other benefit, though, of the connection is that you also have space for the recovery, right? So if you're long-term, so really with a Palantir, and I think I own Palantir, actually. I'm an owner of Palantir, and I just own Palantir. I'm not trying to time anything. I don't know what Palantir is going to do or when. I just am a believer in the fundamental thesis behind Palantir ownership. I happened to buy it when it was much cheaper. I don't know if I'd buy it right now. And I do know that it's a controversial asset because there are some people who think Palantir is amazing and extraordinary. In fact, I saw a list where they were talking about companies that could be the next NVIDIA. And there was one guy who actually said, where are my notes at? There's one guy who actually did say that he thinks Palantir could be the next NVIDIA. Where's my freaking notes, man? But I remember he mentioned Spotify. I'm gonna buy Spotify, by the way. I need to write that down. Spotify. One expert mentioned Spotify. One person mentioned Palantir. And then they asked one lady, they said, what do you think is going to be the next NVIDIA? She said, NVIDIA is going to be the next NVIDIA. So she thinks NVIDIA has a ways to run, largely because they've done such a good job of developing such a powerful ecosystem that it's really difficult for anybody to catch up with NVIDIA, not just because they're years ahead of the competition, but because they create like a walled garden, kind of like what Apple used to do, where literally once you get in, you're kind of in their little space, and the switching costs become really difficult. You can't just come in and eat their lunch. That's not going to happen. All right. So yeah. So let's. So since we were talking about Spotify, let me go buy some Spotify right now. Let's get some stock real quick. Hold on. Let me see Spotify. Let me pop that in. I think I might already own it. I can't remember. I just love. I buy stock all the time. All right. So let me see. Let me see if I can. Yeah, it's $589. And let's see. And we have the stock market analyzer that you guys can take a look at. If you log into drboystockmarket.com, you got the stock market analyzer right at the top of the curriculum section. Maybe Chanel, if you want to grab the link and put it in the chat, you can. Let me see here. All right, so let's go ahead and buy some shares. All right. I don't have a lot of money sitting around, but okay. All right. Okay, done. All right. So yeah, so Spotify is one that you may want to have, and I bet you that it went down today. And so maybe this is the time to buy. All right. So just so you know, just since we're talking about Spotify, the bull case for Spotify is that the subscription amounts keep going up. So they keep on getting more and more paid subscribers, which is a really powerful model. It's monthly recurring revenue. Podcast expansion is really paying off. So it's cutting the cost of their content, increasing ad revenue. The formats are higher margin. They've increased their price. That hasn't slowed their growth. They're a high switching cost. So once people build playlists on Spotify, they're not likely to switch. Also, they're really pushing into audiobooks. So they're really doing audio really well. The bear case is that their profit margins are not that big. They're very thin. They have a lot of dependence on a lot of licensing deals that they have to do, and that can get fuzzy. So that those costs could rise unexpectedly. A lot of competition. Apple, Amazon, and YouTube are all competing. And just for the record, I own shares in Apple, Amazon, Google, who owns YouTube, as well as Spotify. And also, investment in content can be costly, and slowing macroeconomic conditions may cause their revenue to drop. But see, the thing about that is that that's not necessarily a permanent condition, though. That's a temporary condition. So the question is, how much of what's happening right now do you allow to affect your investing strategy? So if you want my 2 cents on Spotify, I actually like it. And remember that when you talk about buying stock, I just really don't want you to overthink it. I mean, think about it. When you go shopping at the mall for Christmas and you go waste money that you're never going to get back, you're not going to really overthink it that much. If you want to get that, $80 TV or $200 outfit or whatever, you're just going to get it and that's it. And that it's going to be wasted money. That those toys you buy for the kids they're not going to be playing with them in a few months. So, but we don't overthink it. Why? Well, because it's like this experience, and you just want to feel good about what you're doing. And I think it's the same way with stock. I would just buy it and and if it doesn't work out, okay, so what? Welcome to the real world. That's what happens with investors. No investor ever has everything work out. There's never a way to invest where you'll never have something go down in value. And the truth of the matter is that if you're investing consistently, you will have more money than people who don't invest, even if your assets don't go up in value. That's the beauty of the world, all right? So anyway, let me hit that button. All right, so let's do a few more and then we can bounce out. Let me see. All right, so Chanel is putting her email address in here, Chanel@BoyceWatkins.com, CHNELL@BoyceWatkins.com. And okay, and Dwayne and Jen are partnering to take over the world. I love that. I think that's awesome. All right, so let's go through a couple more questions and then we can finish up. And I hope that once you're done with coin, you'll go get your certificate and print it out, put it on your wall, tell your family what you did. The fact that so many of you did well on the quiz makes me very, very happy, because even if you're not 100% clear on every single detail, remember, number one, you got this for life. Everything we've done in this class is yours forever. You can keep this, share it with your family, share it with your wife, your kids, your dog, your baby mama, whoever. And